Hey guys, how's it going? And thanks for coming. I'm Nick, and this is Real Life Money, where we talk about real life and money because schools aren't doing that. So let's get started. In this video, we're going over what is the difference between mutual funds and index funds. Now, these are both stock market investing strategies, mostly for the long term, so you can grow wealth. And if you get one thing out of this video, that's what I'm trying to go for, is long-term wealth. You keep doing it no matter what happens, you keep investing. So you get compound interest over the long term. It grows more and more and more and more, and that's what we're going for. Now, I do have another video that went over the difference between stocks and mutual funds. I'll leave a link in the description for you guys to check out. So essentially, if you missed that video, having one single stock, you just have one company. A mutual fund has multiple stocks or multiple companies in their mutual fund. It's like a package of stocks. Now, an index fund is very similar to a mutual fund. It's still a package of stocks. Now, these strategies of mutual funds and index funds are less risky than single stocks, because if you own one stock and it does bad, you do bad. But if you have one stock in a mutual fund in a package and that one stock does bad, it doesn't necessarily matter because you have other stocks still keeping it up or other stocks maybe going higher. That is called diversification. Might be a big word, but very simple concept. Instead of having all your eggs in one basket, you have multiple baskets, kind of. So, let's start with mutual funds. What a mutual fund is that, obviously we already covered that, it's like a package of stocks. So you have managers and teams, they pick specific stocks in the stock market that they think are good companies. So it is their job, they are considered professional to choose the best companies out there, essentially. And you pay them for it. They don't do this for free. Since they're considered professional, you pay them an expense ratio. So let me explain what an expense ratio is. Let's say the expense is 1%. So if you have $1,000 in a mutual fund that's charging 1%, you are paying 1% of your $1,000. So you're essentially paying $10 to have that mutual fund. Now, these percentages could vary drastically, like our example of 1%, there could be others of 0.5, and we'll go into later into index funds, which is hugely different. So with these mutual funds, these teams and these managers, they typically try to beat the market. They try to create certain strategies, maybe income strategies, growth strategies, all these complicated things that normal people have no idea what to do, but they try to do these things, beat the market, and a lot of instances, they don't. So in the end, a lot of these funds are making things more complicated, more expensive, and they return less. It doesn't make sense. So what is this market I speak of? Well, leading into index funds, the market is basically all the stocks out there. So an example is an S&P 500. It has 500 of the largest companies in America. So that's one fund that has 500 companies following the S&P 500. So these funds, these index funds, follow that, the market. That's it. It's so simple. It just mirrors the S&P 500. Other indexes could be the Dow Jones. They have 30 of the largest companies by market cap. And also, like NASDAQ, those are tech companies. So it's easier, right? Instead of finding companies out there that are trying to outperform it, you simply follow what's there. And guess what? Since it is easier to do this, you just pick all the stocks that are there, it is also cheaper. So instead of paying a 1% or 0.5, these index funds, their expenses are like dirt cheap. Like some are 0.1%, some are even lower. So for that $1,000 that you have in there, you could be paying $1 in fees. Now these mutual funds could be more complicated picking all these stocks, and they don't even outperform the simple market. And many of the reasons is because of the high fees. Now the market could return between 7 and 10%. That's kind of the average. It depends what you're looking at. The Dow Jones, S&P 500. So let's say you have a mutual fund returning 7% and an index fund returning 7%. Well, the fees for a mutual fund is going to be much higher. If they're 0.5 to 1%. So you're actually not returning that 7%. You are returning that 7% minus the fees, which is actually a 6 to a 6.5%. Now the index fund, on the other hand, still returns that 7%, but the expenses are dirt cheap, like 0.1. So instead of getting that 7%, you're getting 6.9. Now in that instance, the index fund outperformed the mutual fund because the fees eat into the returns. Now my good old friend Warren Buffett, the billionaire investor, actually suggests these index funds, especially for the long term, mostly because they're so easy to understand. You get into it and they return better than most mutual funds. Now again, these are great for long-term investing, compound interest. You keep investing in these index funds. For the long term, it grows more and more and more and more, and that's how you grow wealth. Now one huge company that believes in these index funds and uses them is Vanguard. I'll leave the name in the description if you want to check them out. Their fees are like dirt low, and they believe in this strategy. I even personally have Vanguard. I have it for a retirement account. Their fees are so low that I personally think it's a great investment because those fees aren't eating into your returns. If you're looking at the fees of these mutual funds of 0.5 or even 1%, that's like 50 to 100 times more than the expenses of an index fund. So that is essentially the difference between mutual funds and index funds. However, not all mutual funds actually underperform the market. There are a handful, you have to search for them, do research, but there are mutual funds that outperform the market. Now, the expense ratio doesn't always necessarily mean, like, if there's higher expenses, that the fund is worse. And I'll give you an example of what I'll use. We're all friends. So I'll give you a mutual fund that I personally invest in. I hate people like, yeah, they're out there. Go find them. Like, I'll give you an example. I use Fidelity Contrafund. I'll leave it in the description so you guys could check it out. You could go on Yahoo Finance, you type in their ticker symbol or their name, and it pops up. You could see their statistics. Now, Fidelity Contrafund was created in 1967. Their expense ratio is 0.68. Now, yes, that is more than an index fund of, let's say, like a 0.1. But I actually calculated their average returns since 67. Their return is 13%. Now, you could fight me on this. I don't care. That's what they returned, if you like it or not. Now, not to be an ass, but their previous returns of an average of 13, that doesn't mean they will continue to return 13%. It just has that track record. They're fairly old, so I believe in them. But let's look at the numbers. The market could average between 7 to 10% if you do an index fund with the expense ratio of 0.1. It's essentially the same of 7 to 10%. With Fidelity Contrafund, they're returning 13. Minus the expense of 0.68, you're still getting over 12% return. That beats the market, and that's an example of an actual mutual fund beating an index fund or the market in general. So in the end, you can do your own research if you want. If you're into it, look into it. Go Yahoo Finance. You can look at their statistics, their performance, their returns. You could calculate it. Or if you want it super stupid easy, just go for an index fund. It's so simple. You just continue investing in it your whole life if you want to. Its expense ratios are dirt cheap, and that's why Warren Buffett and even myself would suggest index funds. No matter what you invest in, they're still a hell of a lot better than savings accounts, CDs. So that's kind of it, guys. That's the difference between mutual funds and index funds. If you want to do the research, there could be some mutual funds out there that are better. But if you want it easily, go for index funds. So if you have any comments, questions, or whatever, you can leave them down below. I'll check them out. And don't forget to subscribe to my channel, Real Life Money, because we go over real life and money, because schools aren't talking about that. So thanks for watching, guys, and I'll see you in the next one.